And welcome, it's Mary Ellen McGonagle here with your Friday afternoon weekly Edge show. Today, as usual, we're going to take a look at the broader markets, a very weak period last week. We'll talk about the impact of the pullback last week, also some of the headline news that drove negative price action, and from there, I will share with you some key events that drove the technology sector lower. And I'm pointing this sector out because it was one of three that were positive coming into this week, but heavy selling later in the week has pushed tech into a downtrend. So here we are with some of that news. First up, of course, is the fact that Middle East conflict is continuing to escalate. In turn, we did see the price of oil as well as safe haven gold. Those prices surged. We also did see the yield on that 10-year Treasury rise to 4.9. It actually got up to 5% today, but closed at that 4.9% level. This is a very elevated interest rate level, which in turn has impacted select areas, namely technology and other high growth, but other areas as well are seeing selling because of this high interest rate environment. Most impactful there is the fact that comments from Fed Chair Powell hint at the prospect that we will see continued tightening in their monetary policy, quite simply because economic data is still coming out strong. We got September retail sales data. It jumped much higher than expected, higher sales by way of online stores. And in turn, we also saw housing starts surprisingly rebound in September despite high mortgage rates. So all of this pointing to an economy that is remaining quite strong and in turn will keep inflation high, and hence that shift in the potential policy outlook from Fed Chair Powell. Next week, we will get some very key economic and inflation data by way of the first estimate for fourth quarter GDP, also durable goods orders, and core PCE data. This is very critical inflation data the Fed watches very closely. And then, of course, earnings season will continue to proceed with both Meta and Alphabet, among many other names, due to report their results. So let's take a look. Where did the markets close for the week? Here we are, a daily price chart of the S&P 500. And we can see that we have fallen below this key 4,300 level, and then today below that 200-day simple moving average, both key areas of potential support that we've now broken below. Not good news, because from here, if we see further selling, we will need to go back to these lows at the end and middle of May for potential support. Also, we now have the momentum indicators, this RSI and stochastics, in negative territory. And also of note is the selling took place on above average volume, and that's not what you want to see. It does point to distribution. So we are on the lookout for further near-term weakness for the S&P 500. Let's take a look at the NASDAQ from here. And we'll see very similar dynamics in the sense that the momentum indicators negative, trending lower. And then this index also broke below key support on elevated volume. So again, not what we want to see. For the near term, at the very least, continued potential weakness. Of course, earnings has been known to reverse the markets. However, given other dynamics, there is very strong reasons to believe that we will see further weakness, at least over the near term. Let's take a look at some of these 11 sectors within the S&P 500 2-month daily price chart view. I have it sorted by this RSI, that relative strength indicator. And here we are, energy, the last group, the only one that is above this key 50-day simple moving average. I talked about that spike in the price of oil, and in turn we did see a pretty significant rally among some underlying stocks within the energy group. And also, as we move forward, I did want to share with you that communication services sector, which had been holding in quite well ever since this period here in March. And this week, it too has now succumbed to weakness elsewhere. It closed below that 50-day. We have a negative RSI, and the MACD is on the verge of closing into negative territory. And this, of note, did pull back despite a very sharp rally in heavyweight name Netflix, which came in with subscribership numbers that were well above estimates. Another area that turned negative this week, and I mentioned this at the beginning, is technology. And you can see this selling certainly over the last 2 days, very high volume. In turn, tech has turned negative with a move below each of its moving averages, negative RSI, and a negative MACD. As we move through, I'll share with you specific areas where that weakness emanated from. Moving through these other sectors, we can see financials had a very sharp pullback, and this was all about earnings. This is XLF, and banks came out with numbers, and they were not particularly good. A lot of that having to do with interest rates being at this elevated level. There's anticipation that lending will be reduced and hence their profit margins. And a number of banks are seeing less by way of deposits as people move their funds toward either treasuries or other higher yielding products. Let's go ahead and take a look at some of the sub-industry groupings beneath these sectors. And I use several ETFs that are really quite helpful. Again, at 2-month daily price chart view, we can take a quick look at gold, which continued to elevate to higher levels as this standard or safe haven security is in a confirmed uptrend. Quick look here at the yield on that 10-year. It did dip above 5. Now we are up here at a very high level. However, there is anticipation that we could easily go higher from here, perhaps up to that 5.25% level before leveling off. As we move through, I'll share with you other areas outside of banking that are negatively impacted from this higher rate environment. Volatility also on the move higher. We closed at about 22 last week. This higher volatility really indicative of the uncertainty with all that's taking shape behind the scenes with the broader markets. And anything above that 16 level is generally negative for the prospects of the broader markets. And as we move through, I did want to share with you the price of oil up here at that 92 level, given that Middle Eastern crisis taking shape. And then also here we are with software stocks. IGV is the ETF for the expanded tech software sector. And this particular area had been holding in, not anything overly vibrant, but certainly well better than the broader markets. And today we did see a 2.5% pullback on very heavy volume, which in turn turned this software area lower. As we move forward, I'll share with you 2 names in particular and the news that drove those names lower, which then spread to other areas. But of course, higher interest rates are not good for this industry group. Semiconductors, which had been relatively weak, also exhibiting underperformance here with a sharp pullback. One of the stronger or certainly biggest names in this group, NVIDIA, sold off almost 8%. We'll take a look at that chart and I'll share with you the news there. But in turn, we can see negative momentum with that RSI and MACD. Most overall is the fact that semiconductors are remaining or now in a confirmed downtrend. The reason that I'm highlighting this, let's go ahead back to that chart. You do want to take note that it was one of the areas that really pushed us. This is a weekly chart, and we're taking you to the beginning of this year, and it was a very strong group going into the end of July. And when you lose this leadership area in the broader markets, it's certainly of note. Now, let's go ahead and take a look at some of these other weaker areas. We talked about banking, KRE. Here's that sharp sell-off, down 4% today. Small cap stocks, they didn't underperform. However, they were not the worst performing indice But we can see this very confirmed downtrend in these Russell 2000 small cap index. And again, this is another area that you want to see vibrancy if you're anticipating a turnaround in the broader markets. So weakness remains there. Let's take a look at some of these tech names. First up, I'll share with you a chart, daily chart of the company Oracle, ORCL, and we can see it was down 6% today. And this drop was all about news from the company that they are anticipating and experiencing difficulties in the build out of their AI products. So that in turn pushed this stock down below its key 200-day simple moving average. The momentum really did not get into positive territory since this break after reporting numbers. So the stock, though this sell-off did reverberate among other software names. Another name that was in the news today was OKTA. This is a well-known software security stock, and it fell 11.5%. All about this particular company is software security related. They are designed to help companies stave off cyber attacks, and in turn, this particular, and unfortunately, OKTA saw their system get hacked, which in turn pushed this particular name quite a bit lower, as well as most of the other cyber security related software names. That's it for this week. Everyone have a fantastic weekend. I'll look for you here again next Friday. Hey, Mary Ellen here with Simpler Trading. Thanks for watching the video. If you liked what you saw, go ahead and hit that like button and leave comments below. And if you'd like to be notified to future videos, you can hit that bell icon and subscribe. Don't leave without subscribing to my MEM Edge bi-weekly report. I do have a special trial offer. And for those who'd like to learn about trading live with us, you can go ahead to simplertrading.com to learn more.